Right. Okay. So, as I highlighted earlier, in question 3, you guys can't see that. In question 3, they required you guys, they said prepare the post-adjustment trial balance as at 31 January 2021, after considering all the necessary adjustments above. Okay? Yeah, I'll zoom in a bit more just now. Why are you sitting where you are sitting? On top of that, you are like me. You have an extra pair of eyes. All right. Can you see now? You're good. Cool. So this is what they gave us. This was the pre-adjustment trial they gave us. Okay. And then obviously we need let's quickly just copy this. All right, just want to copy that so we have something to work with. And then this is obviously going to be your post-adjustment trial balance. Who's that speaking French? All right, so let's go through this quickly. So question 3, what information did they give us? They said additional information 31 January 2021. They said stationery on hand 750. Okay, so what did we need to do here? What needed to happen? What are we doing here? Stationery obviously needs to be adjusted. So here we're saying the 2000, what must happen with the 2000? We have stationery on hand, 750 minus 750. Okay, which gives us what? Guys, did I mark things correct that you did not even do? Must I come there and remark? Because it sounds like you're blank. Like you don't know what's going on. Especially you, I'm ready. Did you get the same balance? See guys, it's possible, right? It's possible. Okay, and then what else must happen? What's the other thing that we need to do? Consumable stores on hand. Okay, and that's obviously an asset, so it's obviously going to be where? In the statement of financial position section. Okay, I don't know if this is the only thing, so I'm just going to put 750 here for the stationery before we actually do anything else. I mean, sorry, before we actually put in the amount for consumable stores. Why am I still sitting on desks? Why? You have so many chairs available. I've been advertising the front for, I don't even in the break. For months. I give up, guys. I give up. Anyway, let's continue. Next one, rental expense, 1,000 per month is incurred for 12 months to 31 January 2001. Okay. And then it goes on to say, dealers has been renting the premises from 1 February 2020. Okay, so where's the problem there? Is there a problem there? Does something need to be adjusted? Where's the problem? Where is the problem, guys? So we've got February, March, April, May, June, July, August, September, October, November, December, and then January. So that's 12 months, right? So is there a problem there? We've got 12,000 in rent expense, and we've obviously rented for 12 months since 1st of February, right? So is there anything we need to do there? But let's proceed. Nothing to do there, right? So we move on. The equipment was purchased on 1 February 2020 and is expected to be used for 2 years, at which it could be sold for 3,000 residual value. Okay? The straight line method of depreciation is used. Okay. So here, what are they trying to tell us? Firstly, they're telling us when we purchased. We purchased on 1st of February. So this is why you immediately need to do your timeline. Okay. So 1 Feb. Sorry, this is 2020. This is 20. And we know that our financial year end is 31 January 21. Okay. So let me just double check here that I'm recording. It better be. Okay, super. So we've had it for the full 12 months, right? The full year. Okay, and depreciation happens at what rate? How do you know it's 25%? How did you calculate? Talk to me, Kate. 3,000 divided by 12,000 times 125 times 100. Okay. And you got 25%. What did everybody get the same thing? And this was over how many? 2 years. So 25% every year is expected to be used. Okay, it's a straight line. So basically you are saying 2 years, yes, used, expected to be used for 2 years, after which residual, okay, that's fine. All right, let me just double check here quickly. Make sure we're on the right track. Okay, so another way that you could have done it, let's see if it comes out to the same, is you could have said, you know that it has depreciated over the 2 years. It has depreciated by how much? If it's got a residual. Remember, residual value is the same as carrying value, isn't it? So we're basically saying in year 1 and in year 2, for those 2 years, it's depreciated by how much? Because remember, the asset, the value of this thing No, not yet. No, we can't. Remember, purchased 1 February. So they didn't tell you straight in the question that the value of your equipment is 12,000. Okay, but they said equipment was purchased on 1 February 2020. So basically, they're saying all that equipment, that 12,000, all of it was on the 1st of February. So then we're saying minus the 9,000. Okay, that gives you how much? 3,000. Okay, so we know that it depreciated by 9,000 over the 2 years. So if we want to find out how much is depreciation, because those are 2 full, this is for 2 full years. So divided by 2, we're then saying it's obviously depreciating at 4,500 a year. Right? 4,500 a year divided by 12,000. What do we get? Do we get the same 25%? What are you guys getting? $375. Mm-hmm. Mm-hmm. So, okay, you know what, guys? We're actually, all we needed to do is to find out how much is depreciated by. Okay? We know that this was bought on the 1st of February. Remember, our financial year begins on the 1st of February, right? And it ends on 31st of January. Okay, they've told us in the first 2 years it's depreciating. Well, they don't tell us how much it's depreciating. We had to calculate that by 4,500. Does that make sense? In the first 2 years. And then it has a remaining value of 3,000. Okay? So what we then can quickly just do is say, okay, for this year, because this is the first year that we've had the furniture for, we know that the depreciation is going to be 4,500. Okay? So we then can quickly, in our depreciation calculation, here, what is an expense? So here we don't have, I'm going to just quickly erase this. Okay, we don't have depreciation. All right, and then quickly we write here 4,500. That's how much we had on depreciation on, what is this? Equipment. Okay, and then here we also have accumulated depreciation. And that's on furniture. So this is, I'm just going to put on, let me do this. It's not furniture, sorry, equipment. Yeah, Bo? Yeah, you should. But if there's any questions about marks, don't worry, just approach me after the session. Then we'll talk. No, it doesn't work like that. I do that. Okay. All right. Super. So that's what they wanted us to do there. Because remember, the whole point of why they've given us that piece of information is to let us know we need to record depreciation for equipment. Does that make sense? Okay. So I think here we were spending time trying to figure out what was the depreciation rate, but we should have just quickly taken that amount. Then the furniture was purchased on 1 February 2020. Can you see here? They just wanted to test your knowledge on depreciation, but they didn't make it confusing in terms of dates and stuff. And is depreciated at 20% per annum using the diminishing balance method of depreciation. Okay, so then we see, so that's furniture. So then we need to immediately to see, do we have accumulated depreciation on furniture? We don't have anything, and plus we purchased on the first. So the good part, that obviously means we take, what is the amount on our furniture? We have 7.5, right? So 7,500. We don't have any prior because we got this on the first, okay? Then we just say times 20%, which gives 1.5. Okay, so we do the exact same thing that we just did now with equipment. Depreciation, we're going to say plus 1,500, and then scroll up, accumulated depreciation, but this time it's, oh my goodness, undo. Okay, let me actually just copy from there. Accumulated depreciation on furniture. Okay, and we said that's 1,500. Okay, so we have dealt with that, right? Then we move on to the next. We have the loan from Time Bank was received on 1 January 2021. So that's literally the last month of our financial year. Because remember, our financial year up until 31 of January 2021. Okay, I've got some people who don't want to be here. Go is there. You can leave. Do you want to be here? Whoever's talking. You guys want to be here? Okay. All right. So then let's give all of us, including yourselves, a chance to learn. That's all. All right. Super. Right. Interest on the loan, 15% per annum. All right. Accrues monthly. Okay. So all you needed to do there is literally then say, okay, we know that we've only had it for 1 month, right? So 1 over 12, okay, because they said 1st of January, 1 over 12 times then, you can say 15% or 0.15, and then you said how, what's the amount? 20 what? Straight 20,000. 22. Okay, I thought I heard someone say 20. Yo. Now I'm just double check. Cool. All right, so it's 20,000 or 20K. All right, what do we get when we do that calculation? 250. 5. Is it 250? Yes. Hey, do I need to correct things there? You let me down, man. All right, super. So then we come here and we obviously have interest expense now. Expense. Okay, are we debiting or crediting? Where? Interest expense. We're debiting 250. Okay, and is there any other account that's affected? Is there any other account that's affected? We know that Every transaction affects at least 2 accounts. So what other account is affected? It's accrued expense. We owe these guys. We might not have paid them, but we owe them. This is accrued. And we know accrued expense is what type of account? What's going on now? All right, what type of account is it? It's a liability. So now crediting that. Can you see the double entry? All right, those of you who didn't write, all right, I hope this is a good revision. All right, preparing you for what's to come. Okay. Let me just insert here quickly. Those of you who did write, I'm sure you're relieved that it's over, right? All right, so then the next one was, second last one, guys, we're almost done. Stay with me. A debtor owes the business 4,500 and they have been declared insolvent. It has therefore been decided to write off this amount as irrecoverable. What are we supposed to do here? How do we go about doing that? 100%. That is what we're going to do. Yes? No, it's not that deep. Credit losses, yes. So credit losses, what are we doing that in the statement of financial position section or nominal section? Where are we doing it? Nominal, why? It's an expense. Okay, so this is credit losses or bad debts. Okay, if you put bad debts, I also gave you your mark there. People are fighting for marks here. Eh? They're making sure. All right, 4,500. They made it so easy for you guys. They didn't say 20 cents on the dollar or 60 cents on the dollar. They just said we're writing it off. So the whole amount. Does that make sense? Okay, guys, we're not trying to. I should use a certain term, but today I'm behaving, isn't it? I'm behaving today. Okay? We just want to see, do you know your story? Guys, I can't hear him. Yeah, that's true. Okay? But you guys would have done your exercises, so you would have known exactly how to treat them. So now what's the other account that's affected? Debtors control, what are we doing to debtors? Is it already there? Yeah. Why are you doing that? Okay? Did everybody get that? Did everybody do that? Why? So how much are we having there? How much should we have? 800. Okay? Right. Okay, and then the last one. After analyzing the debtor's age analysis at year end of 31 January 2021, dealers believe that an allowance for credit losses of 330 should be recognized. What must happen? What must happen here? What must happen? I saw you discussing something. It was accounting, right? Okay, so guys, what must happen? Why? Okay. How did you know that you needed to create one? That's what I wanted to say. That's step number one. Okay? So guys, I want to keep you all in the loop as to what's happening. All right? Whenever you see something pertaining to allowance for credit losses or provision for allowance for credit losses, because we know it's the same thing, first step is you need to check, do I already have an existing? We look, we see in the trial balance, and this is why I scrolled up, because obviously an allowance for credit losses is going to be in your statement of financial position. It's going to be somewhere in here. Does that make sense? So if we do not have an allowance for credit losses, if there's no allowance for credit losses here, that means we need to create it. If it had already been, if we already had one, that means we need to adjust. Okay? So fortunately, they made your life easy. You just needed to create it. So we come here, we say allowance for credit losses. All right. And how much did they say it was? 330. And are we debiting or crediting that amount? I have crediting, I have debiting. Why do you say, in fact, forget that. Hands up those who say debiting. Hands. Okay, so I have 1, 2, 3, and then hands up 4, and then I have those who say crediting, hands up. Even those who didn't write, I want to see hands. Which way are you voting, sir? You? You say? Are you debiting or crediting? No, I'm talking to this guy. I'm talking to you.
I don't know.
Guys, what's happening? You know in the test or exam, you can't say I don't know. What are we doing here, guys? Allowance for credit losses is what type of account? Oh. Yo, guys, I need to see your paper. Dylan, I need to see your paper. You put your hand up for debit. I need to see your paper. Yeah, I need to see your paper. I need to see your paper. Okay, so we're crediting. Remember, allowance for credit losses is a negative asset. Allowance for credit losses adjustment is either income or an expense. Does that make sense? And that's when we would debate whether one needs to debit or credit. Okay, so here now we come to allowance for credit losses adjustment. Okay, so I'm just going to copy that one up there. Okay, right, and paste, and then say adjustment. Okay, and here, because this thing never existed, because our provision never existed, what is this? Is this an income or an expense? It's an expense. Okay, so what are we doing here? Now we are debiting. And you see, debit and credit, they balance each other out. All right. And if you did all of those things correctly, your debit should match your credit. Did your debit match your credit, sir? Yes. I really need to see your paper. All right. Okay. So guys, that was your test. Was this test not fair? It was a good paper. All right.